When you look at your refocus on Asia, how much opportunities is there in China for Prudential?
It's massive. It's so our partner here is CITIC, and if you think of the structural demand in China, it's about a third of all healthcare expenses are paid from cash by the consumer. So our work on health inclusion is hugely valuable. And then on aging, the other core structural demand we're used to, turn of the century at about 9,000 Chinese people that were 100. Now you've got about 250,000, and that number is scheduled to double again. So assumptions on what was the right amount of savings for retirement, how those vehicles work, all of those play to our core strengths and are tailwinds to our business here, which keeps growing.
Okay, so what does that mean? That you want to increase your stake in the GV in China, or would you give more money to CITIC to, the plan is what, getting bigger in China?
Yeah, so there's multiple dimensions to that. So we can and are increasing the effectiveness of the business we have. That's the technology, the training. Now we have a completely digital platform here for the consumer. Not surprising in China.
And that's more attractive for them?
Much more so. It's how they're used to doing business. So Alipay, WeChat are the payment technology, the claims technology, facial recognition is the software for the security, just like the balance of the apps on their phone. That's one. Expanding your license footprint. We now have about 85% of the country under our footprint. Expanding the products. So we're a health and protection provider here, growing multiple times faster than anybody else, but off a smaller base. And then the last one is product range. So we now have a lot of new products in China, but one of the more interesting ones is we're doing 3 trials of pension products in 3 different cities in China, which is, again, a core need here.
So how much money are you putting in China? And again, your relationship with the GF will increase?
That would be another dimension to increase the value we can extract. It's become quite a successful JV with CITIC. It's a 50-50 joint venture, and we talk about ownership and structure in all of our normal meetings, but it's not buying more of it or is not necessarily the only way to increase the value of the business. For example, it grew 45% in sales in the first half of the year. So regardless of your percentage ownership of that, that's an excellent position, and it's very closely aligned to what the government's objectives are. And no government wants to fund a longevity or health demand, and they want to make sure that consumers don't have a financial crisis personally because of those sorts of issues.
Do the Hong Kong protests actually curb your appetite for China at all?
No. So Hong Kong has had a variety of challenges over the years, politically and otherwise, and this is clearly a serious one. Our first lens in that is our employees. We have one of the largest life companies in Hong Kong, as well as a regional office there. But I'm sure everyone that sits here says they're watching it very carefully. We are, and I'm not going to try and predict the outcome. It's certainly changing in nature, but no, I think that there is there's an outcome at some point here on the horizon that return to something resembling normalcy. And we've been in Hong Kong since the early '60s. We've been in China 20 years, so it's not the first thing we've weathered. So we're watching it carefully.
You have quite a lead in Singapore. Any M&A to cement that lead?
We look at M&A across the region. Singapore, I just got back from, one of our most successful markets. 1 in about 2.5 homes in Singapore owns a product, a service from us.
That's impressive.
It keeps growing at double digits. It's sort of an example of what we're doing now in Asia. It's got a group business now that's very successful. It's got a digital side coming up that supports our other businesses. It's got the lead agency model and advice model in Singapore, and the average household there has almost 3 products of ours, which most of the rest of the region, for us, it's 1. So, with 16, 17 million clients, if they trust us enough for a second relationship, that's an important transition for us in the growth of this region. So I love what we're doing in Singapore. I was just there Monday night for the 25th anniversary of our asset manager, which Eastspring, which is doing incredibly well.
But does that mean you like M&A, or you would consider M&A in Singapore, or not, because you're doing so well?
Well, we did M&A for one of the businesses in Singapore. So Eastspring, we've now done 2 purchases of asset managers in Thailand. I think we were underinvested in Thailand in our capacity. Our asset managers are run out of Singapore. That's the headquarters for that part of the business. In Singapore, in country, we have everything we need. And we can organically produce anything that any competitor has. And we're bringing next our digital platform, health platform, Pulse there. And so that'll round out their, that's a piece of their business plan. But it's an outstanding market for us. We've been there almost 90 years.
When you look at the USChina Trade War, does it actually have an impact on how many people want your products, or not at all?
So, it's Great question. So we're seen as a UK firm, right? We're still listed
Although
on the
you don't
FTSE.
actually have in the UK.
We don't have UK business
UK.
anymore, but we are listed there in a FTSE stock, and it's our headquarters. And that definitely is a respected structure in this part of the world. UK governance is a well-proven model, and the risk management, so those sorts of tools are we brought here, and I think are seen as best practice, which is a great thing. On the U.S. trade piece, it's no different than any other political issue. It slows down how long it takes a consumer to make a decision anytime we get political uncertainty, but then it also increases the likelihood they stay with us. So in an investor perspective, persistency, or the likelihood of making that second or third or fourth payment, goes up because people are risk averse. But decisions take longer, and that's true anywhere in the world. That's true in the UK, that's true in the US, that's true in Southeast Asia. We see that pattern emerge across my 25 years with the group.
What will you do with the US business?
So we've said to the investors that our U.S. business is based on the fact that there's structural demand in the retirement market in the U.S. People are undersaved; they need to supplement their savings. We took a fairly unique structure on a product set that's been very successful to the investors and the consumers as well as the investors. But we'd like to diversify that business more, and we've said we're going to do that with outside capital, which is a new model for us. But there's a lot of interest from long-term capital in the U.S. market, and our investors want to see our primary capital allocation to come to Asia. Yep. So you'll see a blend of the two in that market, which is, we've operated through a variety of structures before, and we're working on that now.
Okay, but you're not exiting the U.S.
No, we think it's an excellent market with very high returns for our investors. We have very good products for the consumer. We have an advantage position with the number one provider in the product sets that we're in, and very well liked by our distribution, and great technology set, all those things that consumers and advisors need in what's a very challenging retirement market for the individual consumer.
How difficult are negative rates for an insurer like Prudential?
So I have the privilege of saying we don't own anything on balance sheet that's got a negative yield. Europe was not our market, and we've not, obviously from a return point of view, that's not been something we thought was appropriate to own. We've moved our business in the last 5 years away from what the industry calls spread product, or where you have a stated guarantee and you invest to try and get a higher yield than that. So for example, in Asia, over 80% of what they sold in the first half of the year is fee, health, or protection, and 90+% of it's recurring revenue. So very little exposure to interest rates in what we've been doing, and that's intentional.
But does that mean that you have a big advantage over your rivals? And so how do you play that? So
it's with a 170-year-old firm, you tend to think long. So I don't think that credit crises are avoidable. I think they'll be different by market. I think negative rates of the incremental value of all quantitative easing is diminishing. And certainly, if you've got a negative yield, it's real suspect in what the value is, from an economic policy point of view, to go further negative. So we're not trying to align with non-economic policy. So I like our position. We own bonds that have yields. Yep. We're super high up in credit. We're careful on duration. We assume defaults. And there's changes by markets. I mean, emerging markets have issued a lot more debt than they historically have. Yep. The U.S., which has historically been very liquid, still is, but has different dynamics in terms of buffers and things with the bank's limitations on intervening. So, we assume we look very hard at liquidity, and we look very hard at credit quality beyond just the simple stated ratings.
What is the chance of a recession in the U.S. or worldwide in the next 2 years?
So I think even in the U.S., all these are regional, right? So the U.S. has what looks like good structural growth, but I wouldn't say that's true in the East Coast, West Coast, Midwest, and the South all at the same time. Nor would I say it's true for all of Asia. Certain markets have real structural demand. So we tend not to look at countries in sort of a homogenous look. We tend to look at sectors, and the sectors often have a geographic bias. But I think you could see certain industries, there's been you could have trouble, but overall I think there's growth to be had in the U.S. and there's clearly growth to be had across Asia.